Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. We're currently witnessing one of the most aggressive tightening cycles in history that's already let the market down significantly. It's led market valuations to contract, and a lot of investors are very concerned that the effects of monetary tightening are now going to be felt around the economy and lead to a collapse in earnings, just like the tightening cycle we saw in the early 2000s led to the global financial crisis, and the tightening cycle that we saw in 1999 led to the 2000-2003 bear market. And what's even more concerning is that analysts have already begun revising earnings to the downside. You can see here that negative revisions began in August. So you can understand the huge panic we have in the market right now. Not only are earnings already showing weakness, but the Federal Reserve is tightening at an unprecedented pace, leading a lot of investors to believe that this is only the very, very beginning of a much larger bear market. We're going to look at the data in this video. We're going to assess whether or not that is the truth and these concerns from most market participants, whether they're actually true. If you are new here, don't forget to click on that subscribe button if you want to follow these crazy markets with us. And also, don't forget to smash the like button if you enjoyed this episode. It is really appreciated. And now, without further ado, let's get right into it. Okay, so the first thing we need to assess is whether or not earnings are actually going to be contracting. Here you can see earnings have a massive impact on the market. This is what leads the market higher over time. It's earnings per share that go up over time. This is why stocks tend to trend higher. And you can see when earnings collapse like they did in 2008 and 2009, that is what can create a true bear market. Now, of course, the market doesn't trend like this, right? It goes up and down around earnings. As investors get optimistic, they get pessimistic, but over time, you're going to see the market follow earnings. So the question is now, the Fed tightening cycle that we're seeing today, is that going to lead a major contraction in earnings and therefore trigger a 2008 type of scenario? And the answer is probably yes. Probably that's going to happen. Look at how quickly short-term rates have been rising here. Ever since January of 2022, we've had short-term rates rise at an incredible pace, reaching almost the same levels that we saw since the global financial crisis. We haven't seen rates this high since 2007. So that's already by itself a pretty big statement. So I think people who are concerned about this regarding the economy and potentially the impact that that could have on earnings, they're completely right. This could potentially turn out to have devastating effects on the economy. But the big question is, how quickly is that going to happen? Now, from our observations, and we did some statistical work on this data to try and figure out what the relationship is between rates and earnings. How quickly does a rising short-term rate, so here we use the 1-year treasury yield here, how quickly does that translate into a contraction in earnings, right? And vice versa, how quickly does a falling 1-year yield, so easier financial conditions, how quickly does that lead to an earnings increase? Is there actually a time lag? And this chart is telling us, it's showing us that there is a time lag. Now, typically, economists tend to agree that the time lag between monetary policy and the actual effects on the economy is around 1 to 1.5 years. Based on this chart here, you can see we advance the blue line, so the short-term rate, basically monetary policy, by 17 months. When the short-term rate is very high, earnings are typically contracting, and when the short-term rate is very low, earnings are typically growing very quickly. So this work really does show us when the Fed really begins to tighten, you have to wait around 1.5 years before you feel the effects in earnings. So I always find it funny when people say that earnings are going to contract now because the Fed is tightening. There's a lag that you need to take into account. So if you're trying to guess whether we're going to see a hard landing, right, a tough recession, or a soft landing based on what's currently happening in the economy, you're way too early, or at least that's our opinion. And I'm going to give you a quick example of that. If you take a look at 2008, in hindsight, we know that 2008 was a hard landing, that the tightening cycle we saw between 2004 and 2006 caused extreme damages to the economy and almost triggered a collapse of the financial system, right? Now, with hindsight, we know that this tightening cycle was too aggressive for the economy that was too weak. But look at when the Fed stopped raising rates. Investors were very confident. In fact, throughout 2006, throughout 2007, investors were pricing in a soft landing here. And we can replay how that looked like right here in 2006. Earnings per share were still growing, right? They were still going up all the way to the end of 2007. And the Fed was starting to ease their monetary policy. So a lot of people back here were saying, okay, the tightening cycle is behind us. We don't have to worry about the Fed being aggressive. In fact, they're easing right now. And so this is a soft landing. We can safely say that the market is going to continue higher. But then a year and a half after the end of the tightening cycle, so 3 years after the beginning of the tightening cycle, that's when you started to see the effects of monetary tightening on the economy. And that's when investors started to price in earnings that were coming down, earnings that were looking a lot worse, and eventually just a complete collapse of the financial system. So if we take a look at today, we saw the first rate hike here towards the end of the first quarter in 2022. It's only really been 6-7 months since the tightening cycle really begun. So in our opinion, this is much too soon to make any conclusions regarding the effects of monetary tightening on the economy. We think the effects and the major impacts of this tightening cycle are going to be felt down the road, much later. And we'll discuss when exactly in just a second. By the way, if you're so far enjoying this episode, if you appreciate the time and effort that goes into making these episodes, don't forget to smash the like button as hard as you possibly can without breaking your screen. It really does help push our videos out to more people and makes the effort that we put into making these videos worthwhile. So ultimately, we do think this is going to have an impact, but initially, a rising short-term rate only compresses the valuation part of the stock market because all of a sudden cash is more interesting, right? If the short-term rate is higher, then people flock to cash. They see cash as a better investment than stocks, and so valuations compress just mechanically. But this correction has nothing to do with earnings. So if you're paying too much attention to what's being said on Twitter by accounts that really have very little experience in investing and have no research process, or you're just watching CNBC that's jumping to conclusions about monetary tightening and the impact on the economy, you're going to get very confused about the market. You need to put these narratives, these developments in the market into statistical perspective regarding what has happened in history before. And I'll be very honest with you guys, I can spin any information, any development that occurs in the market as being bullish or bearish. Anybody can do that. You can see tightening as a good thing because investors are less concerned about inflation, and you can see tightening as a bad thing because it's going to have negative impacts on the economy and it's going to contract valuation. So anything that happens can be interpreted as a good or bad thing. And that's why the media and what happens on Twitter is ultimately going to confuse a maximum number of people. When you want to use macro analysis in your investment process, which can be incredibly powerful to understand these macroeconomic cycles and know how to position correctly, if you want to be able to do that, you need to backtest these developments with what has happened before in history. You need to backtest the charts that you're looking at with history, see how it has impacted the markets before, understand the time frame that you're looking at, and then be as objective as possible regarding what the charts are actually telling you. It can be tempting to jump to conclusions and say, oh, short-term rates are rising here, so earnings are going to collapse and it's going to be a 2008. Right? That's easy. That's what you're going to hear on the media. Anybody can do that. Anybody can have an opinion on the market that isn't actually backed by research. But what's the lag in monetary policy? How quickly does an earnings collapse typically happen after a tightening cycle? Is that something that we should be worried about in our investment horizon of 6 to 12 months? These are all things that we're striving to incorporate into our analysis at gameoftrades.net and make sure that you guys are seeing the narratives that are out there You're seeing them objectively with historical context and then actually be able to use that information to have an edge in this market without having to spend hours of your time cutting through all the noise. All of this is summarized, whether you like videos, extensive articles, or short summaries and conclusions. You can filter out the noise and focus on what's important. If you want to join our growing community of investors and see if this service is something you'd find helpful, make sure to grab yourself a free trial by going to our website at gameoftrades.net. Now, in the very near term, the market isn't being driven by earning. And that's something that, depending on your investment or trading style, whether you're very focused on the short term or if you have a broader 6 to 12 month or even a longer investment horizon, you may or you may not want to be focused on what the market is currently focused on right now. And if we're being completely objective, and we've been saying that for quite some time, the market right now is focused on yields, right, and nothing else. And let's put up the inverse of the 10-year yield so that we can see this relationship clearly. You can see the stock market is in direct correlation with the SP 500 as long as bond yields continue to move higher, so lower on this chart. You will see that result in pressure on the S&P that could break down important technical structures and lead to that capitulation move that we've been talking about. You've got the short-term technicals that are still very much bearish with this bearish MACD cross where we had that rejection right at that CPI reading. You had the MACD that was about to cross over, big rejection, and now we've been in bearish momentum for the short term. There's really no evidence right now that the market wants to head higher in the short term and that yields want to head lower in the short term. That could very well happen, right? Macro shifts take a long time to play out, but when they do, they can happen very quickly, right? You can see, for example, in 2018, it took months of rising yields that was very damaging to the market. It concerned a lot of investors. When that trend broke down, you saw a rapid reversal in bond yield. And I'm not saying that's going to happen imminently, but currently we're looking at disinflationary dynamics that are currently occurring, the job market that is showing signs of cooling down, and a Fed that's very much in a restrictive stance. You can check out our last video where we discussed how tight or loose monetary policy currently is, and it doesn't seem like the Fed has much room to make yields continue rising significantly from here. It seems like the bond market is pricing in that the Fed is already very tight. So there are these underlying dynamics that suggest we should see a rollover very similar to 2018 here. But until that shift really materializes, the fact that yields are still rising and are still very high is going to be a headwind for stocks, right? And you can see here we're on the brink of getting a bearish crossover. If that last technical level gives in, you can see what support we have highlighted here. In our opinion, there's not much support under that. If that gives in, if we don't see that macro shift occur right now, these levels should act as a magnet for the market. So you can understand why there's a lot of people very concerned about the current market posture right now. A lot of people looking for this gap to be filled. As we've discussed a few times before, that's pretty much what the consensus view is that the Fed is aiming to get the market down back to those pre-COVID highs. I don't like to have a consensus view, but sometimes consensus is right. And if that channel breaks, the odds of consensus being right increase substantially. Now that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to smash that like button and click on that subscribe button if you haven't already. Now in the meantime, I wish you good luck on your trading and see you next time.